Traders, no two trades are the same. Why would you execute every trade the same? Some trades require more risk than others. And we'll go to the charts to take a look at the S&P, NASDAQ, and Russell 2000. Traders, let me take you to this week's NinjaTrader Charting Edge. Pulled up the E-mini S&P 500 futures here on a daily 20-period, 3 standard deviation Bollinger Bands. Red is the 10-day simple moving average. Gold is the 20-day simple moving average. Everybody's hitting me up and asking me, Anthony, what do you think about the S&P 500? Are the highs in? Is this pullback going to continue? Or is the bull trend intact? The answer is, I don't know. But I'll tell you what I will be looking for, because that's what's most important. Let's go back a little bit. I like to go back and look to see what the S&P has done, any market for that matter, in a similar look than we have right now. If you go back pretty much near the beginning of the year, starting off right around March, chopping around 10 and 20-day moving averages, if you look just at a glance, very little time spent below the 10 and 20-day moving averages. Look at here, maybe what, 6, 7 days, here only 2 days, here only 2 days, here barely 3 days, and here we are now roughly 3-4 days as we are recording this show. So I look at that and say to myself, the most we've had really is this sequence right here. And let's just count it up. 3, 4, 5, 6, 7, 8 days below the 10 and 20-day moving averages, going back to March. So for now, I'm going to look at that and say, okay, how much time are we going to spend below the 10 and 20-day moving averages before we regain them? And I'm also going to look to see what the Bollinger Bands are doing if we continue to go lower. If you look at these Bollinger Bands right now, it's really just hugging the trend of the market. For me as a trader, I really don't like that look at all because they're bumpy. There's nothing clean about it. Like this to me was a clean look. We had this break, we consolidated, then the Bollinger Band started to go up, made significant peaks, held above the 10 and 20-day moving averages. The rest of the time is just choppy, grinding higher. The question is, are we going to continue to see that? And what I'll be looking for is if the Bollinger Bands start to open up on a down move. That'll be very interesting to me because what I want to see is something like this where they're choppy here and all of a sudden we start to break and the Bollinger Bands open and then we either get back above the 10 and 20-day moving averages and hug that top Bollinger Band, or we start to go lower and hug the bottom Bollinger Band. So that's scenario one that I'm looking at. And what that would tell me is if we're below the 10 and 20 days and we're hugging the bottom Bollinger Band, that would be a bearish look. If the mouth starts to open and we get back above the 10 and 20-day moving averages, then it would be a bullish look. And I would think that we would look to continue to grind higher. Or the other scenario is the same old, what we've been seeing. Just chopping around. Maybe we get down near these recent lows. Bollinger Bands still kind of remain bumpy, and we chop around the 10 and 20-day moving averages and maybe hold above them, then maybe get back below them. That's really all I'm looking at. Right now, I think the picture is really unclear, and that's okay. As a trader, for me, it doesn't always have to be clear, but I have to know what I'm looking for. So those are the scenarios I'm looking for in the E-mini S&P, and that's this week's NinjaTrader Charting Edge. Let's talk about a tweet I put out the other day. Managing risk is not just about minimizing risk. It's also about knowing when to take on more risk. In my experience, successful trading is about seizing moments, and some moments require taking on more risk than others. I want to pull up an S&P, NASDAQ, and Russell 2000 chart. Let's start with the S&P. What I want to accomplish with the 3 charts we're going to go over today, starting with the E-mini S&P 500, is the environment. You've heard me talk about the environment all the time. One thing I've learned as a trader is when the environment is similar or almost exactly the same in the major indices, that's a time that I will be aggressive and take on more risk. If there's divergence in the indices and one looks bullish, one looks bearish, one looks choppy, then it doesn't matter which market I'm trading, whether it's the E-mini S&P, Russell, or NASDAQ, I will take on less risk. So as I stated in the NinjaTrader Charting Edge, the E-mini S&P 500 right now is an uncertain environment. I know that the primary trend is still bullish, but what scenarios am I looking for? I'm looking for the mouth to open up on the Bollinger Bands. We stay below the 10 and 20-day moving averages, and maybe we have a bear trend forming. If we start to hold above the 10 and 20-day moving averages and that mouth is open, then maybe we have a strong bull trend similar to what we saw before. Or it's the same old where we're just chopping around the 10 and 20-day moving averages. So right now the environment is unclear, but I know what I'm looking for. Let's move on and look at the NASDAQ. Here we are at the NASDAQ. Now the NASDAQ looks a little different than the E-mini S&P 500 going back to March, but recently they look somewhat similar. Choppy Bollinger Bands as the market grinds higher, holding above the 10 and 20-day moving averages. And take us to where we are right now. The look with the Bollinger Bands and moving averages are somewhat similar, but we're not below the 20-day moving average. We're just below the 10-day in the NASDAQ. So the NASDAQ is relatively a little bit stronger right now than the E-mini S&P, comparing using 10 and 20-day moving averages. But the Bollinger Bands look somewhat similar, bumpy and a little bit flat on the top and the bottom. What are we looking for in the E-mini S&P? Same thing we're looking for in the E-mini NASDAQ. Do we start to close below the 20-day moving averages, the mouth opens, and we start to grind lower in the NASDAQ? If we see that same look in the S&P, then I would have multiple confirmations that the trend is now bearish, and I would be more aggressive with shorts. If we start to hold above the 10 and 20-day moving averages with the Bollinger Band mouth opening, then I'd be more aggressive with what? My longs. If it's the same old that we've been seeing, and maybe we're chopping around the 10 and 20-day moving averages, maybe it's not something that I would take on more or less risk. Maybe I wouldn't even trade because it looks choppy, but at least I know what I'm looking for. Have to be confident in my looks. Next, let's look at the Russell. Here we are at the Russell chart. Now this chart looks very different than the E-mini NASDAQ or the E-mini S&P. As you can see, the E-mini Russell has really just been in a massive consolidation going back till March. But one thing that they do have in common with the E-mini NASDAQ and the E-mini S&P right now is chopping around the 10 and 20-day moving averages as of late, and the top Bollinger Bands are flat. Remember what I said. I'm looking for a scenario where if we are going to stay below the 10 and 20-day moving averages right now, and that mouth opens up, and that Russell starts to go down, hugging that bottom Bollinger Band, that will confirm a bearish trend. If we saw that in the NASDAQ and the S&P, that would make me want to be aggressive on the short side. If we start to hold above the 10 and 20-day moving averages, and the mouth opens up in the Bollinger Band, and we start to grind higher, and we see that in the NASDAQ and the S&P, that would confirm to me across all three indices that what? The bull trend is intact, and maybe we see the market start to take off to the upside. Like I mentioned in the beginning, one thing I've learned as a trader is that when all the indices are working together with the same look, that's a powerful trend, and I could be aggressive in that direction and take on more risk. If we continue to see divergence in the indices, where the Russell continues to do this, maybe the NASDAQ stays a little bit bullish, the S&P is maybe a little bit bearish, and we see that divergence, that tells me to take on less risk. But if they all start to work together and we see the same look, then I could take on more risk and be more aggressive in that direction. Hang tight, I'll be right back with my final thoughts.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Final thoughts for today, traders. I want to use an example to clarify what I was discussing in today's show. Let's talk about three people in a room because we had three markets we talked about today: the E-mini S&P, E-mini NASDAQ, and the Russell 2000. Let's just say there's an object in the room that you want to move from one side to the next. If you have one person pushing that object while another person on the opposite side pushing against you, that object most likely isn't going to move. But if you have all three of you on the same side pushing that object in that direction, it's going to be a cleaner move. Why? Because you have full participation and full cooperation. That's a time to put on full risk, not a time where you have divergence in the market, where you have one market pushing one way and one market pushing another way. Let me take you to a tweet that I put out the other day. A good trading plan is not set in stone. A good trading plan allows a trader to adapt and change course if the market conditions change. Look at everything we discussed today. If the S&P, NASDAQ, and Russell all end up having the same look that I was looking for on the daily charts, then I would be in with full participation and I would be more aggressive in my look, taking on more risk. If I see a divergence between one index and the other, then I may lay off my trading and potentially take on smaller risk. It's important to be able to adapt and change course if the market conditions change. You might have a very strong look in the S&P or the NASDAQ in the coming days, or a very bearish look. But if we don't have full participation, I need to be able to adapt my position size, because I expect if there is divergence for the markets to be choppy in any direction. And remember, traders, micro treasury yield futures are now live at CME Group. To learn more about micro treasury yield futures, go to cmegroup.com/yield futures. If you enjoyed today's show, give us a thumbs up and hit that like button. If you didn't, give us a thumbs down and tell us why in the comments below. And don't forget to hit that subscribe button so you don't miss an episode of Develop Your Edge. You could also DM me on Twitter at Anthony Crudele. And don't forget to check out Instagram, Anthony C. Crudele. That's a wrap for today. See you next week.